All right, let's look at another form. This is Form 945, which is the annual return of withheld federal income tax, and it is used to report federal income tax withholding on non-payroll payments, including backup withholding on certain payments, like the payments to independent contractors who did not provide a Social Security number or taxpayer identification number. Gambling winnings, pensions, annuities, and possibly interest and dividends. These are non-payroll payments, so it's when we're paying them out. Again, we're paying out gambling winnings, we're paying out pensions, annuities, and perhaps even the interest and dividends. We're paying out military retirement. Now, the Form 945 reconciles the federal income tax withheld from non-payroll payments such as pensions and other government payments. And 945 taxes normally are paid through the EFTPS program. However, liability is of less than $2,500, so if the tax withheld is less than $2,500, it can be paid by check, debit, credit, or EFW, electronic funds withdrawal, when the Form 945 is filed. This form is an annual return. It's filed once a year, and accordingly, the look-back period is the second previous calendar year. So the look-back period for 2013, you skip 12, and the look-back period is the calendar year 2011. So coming up, we're looking at, 2014, the look-back period would be 2012. We have DRICO's 945 liability for 2011 is $40,000. When must DRICO deposit its 945 tax liability for April of 2013? Because DRICO's total 945 taxes for 2011 did not exceed $50,000, it is a monthly depositor for 2013 and will deposit its 945 taxes by May 15th of 2013, or the next business day if May 15th is a holiday or a weekend. DRICO uses its 945 tax liability from 2011, its second prior calendar year, to determine its 945 depositor status. And when setting the 945 deposit schedule, 941 taxes are not considered. So we're just looking at the 945 tax liability, not the 941. Then we're looking at the W-2 form. This is a wage and tax statement. It's a summary of each employee's taxable wages and taxes withheld for the year. Employers give copies B, C, and 2 of the W-2 to employees. Copy A is sent to the Social Security Administration, and copy D is retained by the business for the business's records. Employees attach copies of their W-2 to their federal and state income tax returns. Of course, today with electronic filing, those copies are typically retained by the employee and only submitted upon request. Some states and local governments require that employers file copies of W-2s with the states and the city government as well. Now, the W-2 must be provided to employees by January 31st or the next business day if that one falls on a weekend or a holiday. Terminated employees by the earlier of January 31st or within 30 days of the terminated employee's request. The Social Security Administration needs to receive the W-2 information by the last day of February or the next business day if the last day of February falls on a weekend or a holiday. If filed electronically by March 31st or the next business day. States and local areas, what you have to do, you have to check those, and of course they all have websites with information. The dates will vary by state or by city. Employers filing up to 249 forms, W-2 forms for the year, file copy A with Form W-3. Form W-3 is a transmittal or cover of all the W-2s, so it's a summary of all the data on the attached W-2s. Employers filing 250 or more W-2s for the year must file electronically with the Social Security Administration. However, they're not required to file that Form W-3 transmittal. How long must records be retained? Well, the Federal Labor Standards Act requires keeping the records listed below for 3 years. The payroll register, the time cards, the timesheets, payroll tax records, tax deposit receipts, W-4s, personnel files, canceled and voided checks, all of this pertaining to payroll. Work schedules must be kept for 2 years. The IRS requires keeping the following for 4 years from April 15th of the year following the year that the document applies to. Payroll register and payroll tax records, tax deposit receipts, personnel files, canceled, voided checks, the forms we've just gone through, 941, 940, 945, and all the supporting documents for those forms. The IRS also requires the keeping of the following for 4 years: a return W-2 from the date it was due, a W-4 from the later of the date the company received it or when last used to calculate federal income tax withholding. When do wages become taxable is very important. Wages are taxable in the year that employees have constructive receipt of the pay. That is, when the pay is available to them. Example, December 2011 paychecks distributed to employees after Christmas, but not picked up by some employees until 2012, are still taxable to these employees in 2011. They were available. It's not the businesses or the IRS's responsibility as far as making sure they pick them up. The employees have to pick them up. If wages are earned in late December 2012, but they're not paid to employees in 2013, then those wages earned are taxable to employees in 2013 when constructive receipt. Wages are taxable in the year employees have constructive receipt of their pay, unless the employer has a formal deferred compensation plan. It cannot postpone paying wages to benefit itself or an employee. So the employer cannot decide and hold wages from one year to the next or move them. Advances and overpayments are taxable in the year that they are constructively received. If repaid the same year, you deduct from taxable wages. If repaid in a subsequent year, you consult a CPA or tax attorney. You report SUI, state unemployment insurance, the state version of FUTA, the Federal Employment Tax Act, as follows. You file the state unemployment insurance returns quarterly. Taxes generally are due the last day of the month following the end of the quarter. So if January, February, March is the quarter, that's first quarter, then you would file the return by April 30th, generally, but you need to check with the state. Wage detail reports are generally filed quarterly. State unemployment insurance rates vary by employer payments in previous years for unemployment premiums and for unemployment insurance benefits. Some states also require the employers, the employees, or both to pay state disability insurance. Generally, employers must file a copy of employee W-2s with the state. In most states, the deadline is the last day of February. If filed electronically, March 31st. Some, but not all, states require filing a state W-2 or copy of the federal W-2 and may or may not have their own W-3. You have to, once again, check state law. For states with no state income tax, no W-2s are filed with the state. There are several states that do not have state income tax. Texas, Florida, Wyoming, Tennessee, Alaska, just to name a few. Form 1099 is filed to report payments to independent contractors or investors. 1099 miscellaneous, MISC, reports non-employee compensation totaling at least $600 for the year in commissions, fees, royalties, rent, and other payments. It is used primarily for independent contractors. It is not used for employees. It is used for independent contractors. A 1099 int is for interest. It reports interest paid. A 1099 div is for dividends. It reports the dividends paid. A 1099R is for retirement. It reports payments to retirees for annuities, pensions, IRAs, etc. A Form 1099 is due to recipients. They must receive their 1099s by January 31st. Same as for W-2s, need to be paid to be distributed to the employees by then. The IRS must be filed by the last day of February for paper returns, by March 31st electronically, and you file each kind of paper 1099s with a separate Form 1096. It's a transmittal. It's called an annual summary and transmittal of U.S. information returns. Electronic 1099s do not require a 1096. With all paper forms 1099, miscellaneous, file a 1096. With all paper forms 1099, interest, a separate 1096. So for the different types of forms 1099, whether it's miscellaneous, interest, dividends, retirement, they require their own individual 1096 for paper forms. Then we move into a payroll register, and a payroll register is where we're reporting payroll as part of the accounting system. And the payroll register includes, for each payment, a check number, an employee's name and social security number, the gross wages or salary, which would you'd have regular pay, overtime pay, bonus pay, commissions, all of that would be listed. Federal taxes withheld, FICA taxes withheld, and usually FICA is split into two parts, the Social Security, the OASDI, and the Medicare, the HI. We have to track those individually because one has a ceiling limitation, the other does not. We also would include state and local income taxes withheld, so the state and cities, other deductions that are voluntary such as health, dental, life insurance, union dues, uniforms, etc. These are voluntary and they can be deducted from the paycheck. Net payment is going to be your gross wages or salary less all the deductions for the net payment to employee or the employee's financial accounts. Each payday you will record two journal entries. The first one is where it involves the employee's salaries and deductions, so that's the payroll distribution. The second one, the second journal entry, is the employer's share of payroll tax expenses. These are the amounts that do not come out of the employee's paycheck. This would be like FUTA, federal unemployment taxes. It would be the employer's matching of FICA, the Social Security, the Medicare. It would also, if there's any state unemployment taxes to be paid, it would be in this. The first journal entry the payroll distribution would look like this, where you're going to be debiting salary expense, crediting your FICA, your federal income tax, your health insurance, your union dues. All of those four I've just mentioned are liabilities. They may very well all have payable on them. That would make it easier to identify. And then a credit to cash is for the net the net payment. Here's an example. In the pay period ending May 10th, 2013, Zyco's gross wages are $25,000. Zyco withholds from employee pay $1,912 in FICA, $1,912.50 in FICA, $4,500 in federal income tax withholding, and $400 in state income tax withholding. The first journal entry is to debit salary expense for the gross earnings on May 10th, $25,000, to credit each of those liabilities for FICA, federal income tax, state income tax. I would have payable on all of them for their respective amounts, and the net pay is to take $25,000 less all the deductions, the withholdings, and the net pay is the $18,187.50. The second journal entry for the employer payroll taxes, each pay period the employer incurs not only the salary expense, but the employer is responsible for the payroll expenses as well. So that's the employer share FICA, the matching, as well as SCUDA and the state unemployment taxes. So this would be payroll tax expense for the total. The FICA matching of the employer would be a liability credited, and you may want to split that into OASDI and the Social Security portion and the HI, the Medicare portion, the FUTA tax payable, and the SUTA, or the state unemployment insurance payable. So all the credits sum to equal the payroll tax expense. Example, in the pay period ending May 10th, 2013, Zyco incurs payroll expenses of $1,912.50, employer FICA of $200, $200 FUTA, and $295 for state unemployment insurance. The second journal entry then is to list the $1912.50 as the FICA employer payable, the FUTA payable of $200, the state unemployment insurance payable of $295, for a total payroll tax expense of $2,407.50. Another journal entry is recorded when all withheld and employer taxes are remitted to federal and state agencies and vendors, such as insurance carriers. So in this case, when it's paid, you're going to be debiting all those liabilities for the employee FICA payable, the employer FICA payable, the federal income tax withholding payable. If there's a state income tax withholding payable, it would be debited when you're paying the debt, the liability. And employer health insurance, employee health insurance, those amounts are also debited when paid. They're normally set up as liabilities and then paid as a payable. You credit cash for the total. When the end of a period falls in the middle of a week, for example, October 31st, 2013 falls on a Thursday, accrual basis companies must accrue their payroll expense. And this was explained in detail in mastering adjusting entries. For example, Compco pays employees every Friday. 1 year, December 31st falls on a Wednesday. Compco must accrue 3 days payroll expense. That's Monday, Tuesday, and Wednesday for the current year, even though it will not pay employees until Friday, January 2nd of the following year. So they're going to have to figure out what that sums to be and debit the salary wage expense for that and credit salary wage payable.